All right, welcome back. I've received and come up with enough questions to answer and make another video out of. I don't know how long this is going to go, so I will post some timestamps down at the bottom so you can skip through to any particular question or answer that you may be looking for. That way you don't have to watch the whole thing if you don't want to, hoping it's not any longer than 20-30 minutes like usual, but just in case, I'll post some timestamps down below. So I've got a number of questions here. The first one that I'm going to cover, these aren't in any particular order either, so if the explanations kind of seem out of order, I didn't really organize these, so I just wrote them down and we're going to answer them. So one of the first questions I think there was a percentage value that I might have needed to come up with, but we'll go through and see what it looks like to answer this question. The first one was asking about re-entering a trade when how do I put this in words? Okay, so you enter your trade, price closes over the inverted fair value gap, and you enter. All the other conditions are met, right? Price moves to your 12-point TP, and you close your trade, or take half off, or whatever your risk management is. Price comes back to the inverted fair value gap after hitting that TP. Do you re-enter expecting a bounce off of that inverted fair value gap in your direction, or do you not? So I'll show you what that looks like so you can have a quick visual of it. I'm just going to pull some random price action here because I don't like to cherry pick and have everything all prepared and looking all perfect. So we'll just pick something random and be as, transparent and genuine as possible. So let's see. Thursday morning was pretty crazy. I wonder if... Okay, sure. This is at least will give us an idea. Let's see. Okay, so there was a 1 hour fair value gap here. That price came into. There was... Try that out. There was a 1 hour low that kind of was equal lows if you want to think about it like that. Not equal lows on the 1 hour, but 1 hour low was swept. We're in a 1 hour fair value gap and it starts trading away. I would have been looking for longs in here. I don't typically trade after 11, and eventually I'll go through a whole breakdown of every single piece and facet of my trade strategy. I may also wait and put that kind of, kind of in a more paid or premium section to give you all the nuances and why this works for me. Hopefully it'll work for you too. I can't tell you it's going to work for you. I can't teach you that this is going to work for you. I can teach you why it works for me. I'm not going to tell you it's going to work, but I can tell you it's going and it has worked for me. So take that with as you will. So, okay, so let's draw this out quick. There is in very small, even smaller than that, very small inverted fair value gap. Size doesn't seem to really matter. So it's so small I can't even grab it, but it counts. Come on. There it is. Okay. So nonetheless, we've got a sweep of a 1 hour low within a 1 hour fair value gap, closes above an inverted fair value gap, and we enter. Now, let's say, I think this is more than 12 points. Nope. Okay. Knocks us out of the trade, closes with 12 points profit almost immediately, right? Then it comes back down to the inverted fair value gap, bounces around a little bit, and takes off again. So the question is, do we re-enter off of the inverted fair value gap? Or I guess, yeah, make a new entry. And that depends. My initial answer is no. And I'll show why that is, but actually I'll show why that is right now. So let's go over to, I set this up a little better, I think. You should be able to see my spreadsheet. So let's go over to these quick stats I have over here. What I've calculated, each step of the trade process is how often does price return to break even after it hits TP1. This happens about 50% of the time. Why I say no to re-entry off of this is because, let's see, it comes back 50% of the time, but from that retracement and then continuing on to my point of my target, my overall draw level, it's only 12%. And the stat that I was going to calculate is, and I could probably do that and just maybe fast forward through some of my spreadsheet formulas, but what I wanted to calculate was if price comes back to break even, what percentage does it go to my stop loss? Because it could come back and then react but bounce around a little bit or not quite go as far as the draw, and you could still technically take another 12 points off of it potentially. So I don't have that calculated, and maybe I will and kind of stitch it to the end of this video or something. But my initial thoughts are no, because it only reacts and continues 12% of the time. The other reasoning is, if you look at the screen here again, if you are not taking full TP at 12 points, you still have a trade left here. And depending on where you put your stop loss, I just do 12 points. Sometimes it's not quite enough. Sometimes it's fine. We'll talk about that in a second too. If you leave some on, you're coming back down and you're going to get stopped out before you hit that inverted fair value gap. So if you've left something on, the inverted fair value gap will always be in drawdown somewhere. And in this particular example, it's so far into drawdown, it's past my acceptable losses for my stop loss. So again, no. So like I said, I think I'm going to calculate how often I can run through some of the stats. How often does it bounce off of here? And you'll see another reason. My third reason is after entry, your ideal first take profit is the next immediate buy side, which is right here. Close enough to 12 points to set it there, 12 points seems to be a pretty good number, 10 to 12 points. Hits it pretty quick. It's a good return on the trade, and hits 10 to 12 points pretty easy. But once it hits the immediate buy side, internal buy side, how does it also hits this one and this one in this particular setup and reacts with fair value gap here, a CIBI. But if we think about it in the way ICT teaches things, how does price move. It's typically said that price moves from internal liquidity to external liquidity, to internal liquidity to external liquidity. And then if you look at price reversals and things like that, it'll move from like external to external or something like that. But we've taken internal liquidity. So there's a possibility now that we've hit all of these conditions, taken internal liquidity at these, as people are shorting and they're chasing their, or trailing their stop down. We've taken those stops here. Who's to say, you know, now we're not going to continue short, because this price leg kind of is already a bearish leg. And what this model is doing, it's either catching a reversal at the bottom, and in this case it does reverse quite far back up to origin, but we can also take retracement scalps, where it's, you know, it's coming down, retraces a little and continues because it needs to knock out a couple of people, gain some liquidity, and then continue on southward or whatever direction you're headed. Bearish retracement scalp, and it continues on. You have no idea. You have no idea which one that's going to be. Which is why I like to leave a runner and close break even, because if it is turning around, you still have position to catch all of this. I mean, 12 points is nice. 10 points is nice. Consistently, that's enough profit to pass a few challenges like I've done myself. But when you start reacting with other PD arrays that follow the order flow, you've taken some liquidity, it's more risky, in my opinion, to have it come back and tap away. Now, there are other examples I'm not going to show where the inverted fair value gap is a whole lot closer to your entry. And, you know, again, that might make sense. Honestly, in my opinion, it just doesn't. It just doesn't make much sense if your first TP meets any of the conditions that I've covered here. If it hits a fair value gap on the down or on the opposing leg, if it takes any liquidity at all, any immediate high or low to the left, I would say no, because there's a good chance that it will then move to the external liquidity down here and just take you out anyways, or just blow right, you know, it's coming down, so you enter and it just keeps on going. To me, it's just the probabilities aren't as high when it does these kinds of things. So long answer short, I think I've covered that pretty well. All right, so I did the calculation that I was mentioning in the video. Hopefully I put this in after I've mentioned it, but this is recorded after the fact. So what I did was went through each individual screenshot and calculated if it hit TP1 after entry, which, assuming you close the trade out, you got your 12 points, you're done. It comes back to iFVG to the iFVG, and you re-enter for like a tap and revert kind of thing. And then it goes to a TP2 as opposed to a stop loss. So if it gets you like another 10 or 12 handles, basically if it bounces off and doesn't go through it, if those conditions happened, I put a yes. If price never came back to the iFVG, I put a no. If price came back and just blew right through it, I put a no. If I didn't have enough bars on the screenshot to determine, I left it blank, so it's not calculated. So what I came up with was over here, only 22% of the time does it come back to the inverted fair value gap for a limit order entry to tap and revert and have it pan out successfully. So in my opinion, again, to answer the question, I would not do that, but that's just me. I would take the close over it, and you have an 86% chance that it will go to at least 12 points and a 44% chance that it'll go all the way to your draw, which is pretty good there. Only a 12% chance to come back to break even and then return to your draw. Usually if it comes back to break even, it goes to the stop loss, which is why I kind of figured this would be pretty low. If it comes back to break even, one step lower than that is going to be the iFVG, and then next is your stop loss. However, I calculated this as a totally separate entry after your first TP was hit. I hope that makes sense. I can show a couple screenshots really quick. So okay. There was also some examples where the iFVG and the 1 hour FVG overlap. So it's hard to determine if it bounced off the iFVG or the 1 hour FVG. My guess is it's probably more than 1 hour, but I put a yes anyways because it fits. So we came down, we rated. I've got an iFVG here. It closed above. I took an entry, 12 points. Done and done. It comes back and technically bounces off the iFVG, but also bounces off the 1 hour and goes for another TP. So technically that one's a yes. Let's see another yes that doesn't have that condition. This one, bear with me here. It's a little messy. So here's the raid of the high. It closes over the orange box, which is right here is the close, my entry. It does retrace to it, which I also document right here. Retrace to iFVG. This is retrace to the iFVG before 12 points is taken. And basically this then is retraced to iFVG after 12 points is taken. So it does, did I put that on here? Retraces to iFVG 57% of the time while you're in the trade and have it still pan out successful. And 22% of the time it retraces after you're out of the trade and have it be successful. So it definitely drops. Why? Because typically, this isn't an example of that, but typically after you take your profit, you're going to end up taking liquidity. So it's going to want to move past the next higher low. It's not usually going to bounce, as I kind of explained in the last video. So anyways, it takes 12, kind of wiggles around, and then comes back to the iFVG and makes another run for at least some kind of profit. And I'll show one more really quick. That one's a big messy screenshot. This is why I don't like PM. Oh yeah. Let's do this one. Okay, really close encounter, but comes up and raids our high. Here's our major high. It does raid itself again. Closes over our iFVG and we enter. Slams right into our TP. So now we're out of the trade. It does come back. You could do a limit order reentry, which is basically at the same place. You see how my entry is a tick below that iFVG. So our stop loss is going to be pretty similar. If we were to re-enter, it does dig in, come back, dig in a little more, come back for a TP. So this would have panned out. But you can see the difference here. I mean, just even this single example, but if you were, now that I'm going to make this public, if you go through and look at my spreadsheets or my screenshots on the spreadsheet, you'll see my original concern for looking at this is I hate price, limit order entry on a fair value gap, and then having to deal with this. Is it gonna turn around or not? And it drives me nuts, right? It's a very tough psychology thing. It really is. Not to say you can't overcome that and you can't have confidence in in what causes price to bounce and what doesn't, and learn that. Lots of people do, and are very successful. I found a different method that works very well for my psychology. My entry is, I don't know if I can, yeah, I can zoom up. My entry is right here. I dealt with this wick for drawdown. Entered, it came up, slammed down, closed here, it came up a little more, slammed down, and I'm done in 2 minutes. That's why I like this versus your typical limit entry. Comes up, taps your iFVG. You deal with, this is a 12-point stop, so this has got to be 8 or 9 points of drawdown. It starts to look good, goes back into drawdown even further. Then it starts to look good, gives you one more, and then takes off, right? So how long is this? If you entered here, so we'll call this candle 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 minutes. You're sitting here sweating. And obviously, as you work on your psychology, that gets better. I'm just saying, comparatively speaking, I entered here and I was done in less than 2 minutes with minimal drawdown. Those are the trades that I like. The super clean ones, I have a couple, but a couple really clean ones that just, you enter, boom, I'm done. I am done so fast. This one, it's going to be very similar. Raids it, closes, enter, boom, done. I love it. So I don't have to sit and wait around for price to decide if it's going to reverse on my limit order and go the way I want it to. So it doesn't happen super clean like that. Doesn't happen a lot. I'm not even going to say it's half the time. So don't think that like this is the fucking godsend strategy out there. It works really well for me and how I work. So I can only teach it and show it and hope somebody else, can learn it and it works for them too. The point is, like I was going to say, it doesn't happen every time like that. But if you get very picky, very choosy, I mean, if you look at all these, let me scroll back so you can see the dates. These horizontal lines are dividers, weekly dividers. So sometimes I'm only taking 2 trades a week because I look for very specific things. And I'm very, very picky. I don't take every inverted fair value gap strategy or setup. I don't take every single one of them. And if you do, you're going to lose. That's not what it's about. It's not mechanical. It's you have to read the market, like I explained in the previous video. You have to know how to read the market. You have to know how to read liquidity. You have to get familiar with being able to determine the general direction that price is going to go. And reacting off a 1 hour fair value gap helps me determine that this is the way it's going to go, and I can take at least 12 points. I mean, the average candle size for NQ is 12 points. You know what I mean? But because I'm so picky, I don't get a trade every day. Look at this gap. March 9th to March 20th. I sat there. Imagine sitting there every single day watching for just a nice clean setup. And you don't get one for 10, that's 2 solid trading weeks. That would kind of suck if you think about it. But if you know that this works, if you know that clean setups exist, super clean ones, like I just showed you, I mean, some of them aren't. I took screenshots and trades of choppy ass trades because it's good to have in your repertoire. It's good to have exposure. Look at this ugly ass thing. It still worked. So I just, I wanted to take some ugly ones too to show that it's not all a 2-minute run to your TP. There is a little bit of sweating sometimes. If this was live, would I have avoided this? Probably. Going bullish into a 1 hour fair value gap is usually not a good thing. If it decides to act as an inverted, price is going to continue going down. After that big down candle, it probably wasn't the highest probability trade, but I took it nonetheless. And in order to show an example of that, I will also say I don't, unfortunately, have the proof of it anymore. Maybe I shouldn't say because it doesn't matter. I did actually take all of these trades in FX replay. Every single one of these was actually taken. I didn't like play price out and then go find one that worked. You know what I mean? And there's a screenshot or two in here that actually shows executions that worked. There was one that was at like 340. I can show you at least that. I should have done it for all of them, and I thought about it, but yeah, this one. So I think this one was 2 contracts or something like that. Nonetheless, the trade was taken. So I had, at one point, had executions for them all, but my FX replay account expired, so I don't have it anymore. But that's not really the point. So that was to answer that question. Honestly, if you want to stick with the highest probability stuff, I wouldn't do that, which is interesting that ICT teaches the tap of the inverted fair value gap. I think it's very, very specific to a certain condition. I just think about it differently. I don't think about the tap of the inverted fair value gap as reason for price to revert and go the direction I want it to go. I think of it as the close over, the failure of the fair value gap in question means price is going the other way. So I can enter while it's going and not hope it turns around. To me, it's just better for my psychology. It just worked out better for me. And turns out through extensive testing, and I'm going to continue to backtest, this spreadsheet will be added to, that it is actually a pretty solid strategy. And like I said, I'm sure you can find others online that also trade something very similar. It's not groundbreaking. It's not new. It's not like completely unique and unheard of. Other people out there do trade this. I did discover it myself and evolving from Cam's model, but that doesn't mean others haven't either. So I'm sure there are others out there that do trade this similar style, but I don't think anybody trades it the exact way I do, and that's fine. Everyone's going to trade something a little bit differently between each person. Even the 2022 mentorship model is traded a little differently between person to person. So anyways, hopefully that answered the question. Which time frames are used? This was asked I'm answering it in 2 ways. What time frames are used for this and what time frames are used for Cameron's ICT model? On both of those strategies, I used the 1 hour up here, the 5 minute down here, and the 1 minute over here as my finite entry time frame. In the inverted fair value gap strategy, I don't really pay attention to the 5 minute a lot. There are a few things that I kind of look for: 1 hour fair value gaps or 1 hour highs or lows, external highs or lows, to start the checklist of this inverted fair value gap kind of strategy. And I like that in both of them, both strategies, because price almost always reacts in some way to the 1 hour fair value gaps. It's a high enough time frame that you still can get multiple entries, and you can still it's strong enough that you get reactions off of. Whereas if it clears out the noise a little bit. If you look at all the 5-minute fair value gaps, you'd have an entry every 10 minutes, and some of them work, some of them don't. So it's just much higher probability in my back testing that this is all I've tested. Just 1 hour. Just stuck with it. I'm like, I like the 1 hour. I'm going to stick with it. When ICT started first explaining the model he gave to his son, it was either the 1 hour or the 15-minute. And I was like, you know what? I'm just going to go with the 1 hour. I like it. And so far it works really, really well to look for those initial points of rejection. So the 1 hour fair value gaps are what I look for to start either trade, either strategy. And then entries always on the 1 minute, even with the model that he gave to Cameron. They were playing around with the 30-second chart, and that's fine and dandy, but I'm not going to pay for that. So I just went with the 1 minute, and it's all fractal, so it did work out plenty well enough for me using the 1 minute. So with Cameron's model, then you would look for a reaction off of a high time frame fair value gap like this one. Then you would go onto the 5-minute. And look for a 5-minute up close candle. After that candle has closed, you then look for a tap of a 1 minute fair value gap. So I can run through that really fast down here, see if there even was an entry. So the first up close candle closed at 11:20 right here, but it did not leave any fair value gaps for us to enter. So we wait. It actually formed 2 of them. So the next one closed at 25, and that one was just kind of chopping around up there. But anyways, then we got some down close candles. It happens to take another low. Then we get a very large up close candle. Super. After it closes, which was started at 11:45, so 11:50, it closed at this very top peak candle. So that makes this fair value gap the one we're looking for a Cameron's model entry. And depending on your risk management, that would not have worked for me, and it wouldn't have worked for the way ICT describes it. In fact, yeah, well, this is 12.5 actually to cover spreads, but he says 12-point stop and a 10-point TP. I just went 1-to-1 with mine when I was doing it. But anyways, 12 points would not have worked. So when you see fair value gaps that are this large, you can do a couple of things. You can enter at the consequent encroachment of it. In this case, also still not enough. You can also enter when price closes above it, which is this candle. That's what I started doing that led to this strategy. So that one did work if you waited for that. So it's just, often this works. This is a very large 10-point fair value gap. So it didn't hold. It actually reacted off of this whole down close series as an order block. So it actually really reacted off of that. Somewhere inside of it, which is even a larger PD array than this fair value gap. But, nonetheless, that's how I look at Cameron's model is you got to wait for it to come into high time frame, 1 hour fair value gap. You wait for a 5-minute opposing close candle, and then you look for a 1 minute fair value gap to tap off of. I didn't like that. So like I said, it evolved into this for me. And it works. It's worked well enough. So let's move on to the next question. Which time frames for high time frame PD array? It's always the 1 hour that I look for. Kind of already answered that one. So, okay, so why inverted fair value gaps? The logic behind it, failed PD array theory. So why inverted fair value gaps? So let's look at, this is actually a decent example. Let's look at this. Same trade to explain that logic. Inverted fair value gap. So if you were thinking about this not with an inverted mindset, if you were thinking about this with a normal SIBI mindset, price is moving down. You can see it's doing that quite expediently. It's reacting. I mean, it blew through these couple, but that's a pretty big drop. So it's balancing that leg, reacting off of a SIBI, and continuing lower. And even inside of here, there's a little one here. It does, more or less disrespect it, but it continues on with order flow. There's one here, got some nice wicks through it, and continues on. So it's respecting SIBIs and continuing on with its bearish order flow. You're going to, it comes up, reacts off of this one, continues bearish order flow. So you can see the pattern here. And what I look for is for that pattern to break. So as people are entering off of these SIBIs, sure, there may be some strategy that works for them, that they can enter the top of this SIBI and it moves the other way. Standard ICT fair value gap entry. I mean, 2022 YouTube mentorship model is basically just that. And so what I look for with this inverted fair value gaps logic is a break in that pattern. And there are, like this one, there are some that kind of fake you out, just like there is with any strategy. 2022 YouTube mentorship model has fake outs all the time too. Is that really a market structure shift? Is that really going to react off the fair value gap? There's always fake outs in any strategy. This one, if you analyze it a little closer, this one didn't work out because it was waiting to take this low. And if you look at this wick, that's, it's pretty substantial wick, and it's within a 1 hour fair value gap. It was waiting for that. So after that was taken, it finally impulsed pretty good displacement here and closed over a SIBI. First time it's really done that. I mean, even this close over didn't really have much impulse. It didn't take a major low. It's a nice reaction off of consequent encroachment, which I almost never use, by the way. But it didn't really have that, like this displacement compared to this. Which one's more obvious? You know what I mean? By the time it closed, it hadn't yet taken buy side, so it's a good valid entry point where you don't have to fear it's going to turn around on you. If you already take buy side, it's going to come back down. So if there's too much displacement, it's not a good entry point. And if there's not enough displacement, it's not a good entry point. But the logic is that this PD array has failed. And if a PD array fails, like just imagine in your head, I wonder if I can get it up here at the top of this. Not really. Not really, but I think I can sketch it out. So like 2022 mentorship model in a nutshell. I don't think this is a good example because there was really no rate of any highs up here, but price comes down and market structure shifts after this bullish leg, and you're like, okay, it's probably turning around now because there's my market structure shift. And let's say on a different day, price returns to this fair value gap and fails. Where do you think price is going to go next? Probably going to go up to this high, get more liquidity, and try again, or something like that. Or continue. This was just a retracement downward, not an actual market structure shift, and it's going to continue bullish. Either way, it's going to close over this fair value gap and continue to the next immediate swing point at least. How many times have you seen that happen when your 2022 mentorship model fails? And so I capitalize on that. Price comes back up, closes over it here. I've got no other fair value gaps in my way. So pretensies, you take an entry there and you hit your 12 points before you even get to buy side. You know, buy side's 20, 30 points above you. So that failed PD array, I mean, what happens? Let's imagine this traded into a fair value gap down here, or even a 5-minute fair value gap, and then came back, closed over this one. How many PD arrays are either failing here or being respected opposite of what you are trying to do, opposite of your 2022 mentorship model? All confluences then for my inverted fair value gap strategy. And away we go. So that's kind of where that came into, as well as kind of the other detail I mentioned in the last video where I was waiting for price to tap and move away because I was unsure if it was going to tap and move away. So when it moved away, closed outside of it, usually closed over some fair value gap that it had printed on the way up, thereby an inverted fair value gap. So it's kind of evolved into that. So that's kind of the theory behind it. I already covered those time frames. I'll cover that in a second. Stop loss being the biggest struggle. What's acceptable for losses? Okay, so this was something I wanted to talk about myself. I wasn't asked any questions about it. What I find difficult in my entire trading story so far is I can find entries all over the place. I can tell you where price is going to go. And I can tell you where those entries are. The hardest part that I have found in all of my trading, all of my testing, everything combined, is putting a stop loss that will save me from extreme losses, but is also big enough to allow the trade to pan out. It's tough. I mean, how many times have you seen your stop loss wicked through and then price explodes the way you want it to and hits your target? And it would have been great had you added 3 points to your stop loss. You know what I mean? That has definitely been the biggest struggle, and there isn't really an answer to that I have found yet. Not to say that there isn't one, but I've done everything as far as put your stop loss below or above. We'll just stick with this example because you just flip it for a bullish or a bearish trade. But you're taking a long, you put your stop loss below the low. That sometimes is huge, especially with this, because you're waiting for some bullish movement already. So that ends up being massive. I'm not comfortable with taking that kind of loss. Some you could use, like we wait for a close above for entry. We could wait for a close below for a stop loss. Sure. You guys know how fast NQ moves, right? So, I mean, sometimes a close below could be 30, 40, 50 points. Sometimes it's only a couple, but also, how many times does it close below and still continue on? I mean, things like that happen. So it's just been really hard to determine and find something that I'm happy with. So my advice is pick a stop loss that encompasses a value that you're okay with losing, that doesn't hurt to lose. For me, it's 12 points. I mean, losses suck in the general sense, like, that blows, and I have to get a win to make up for it, or whatever. Losses always suck, no matter what game you're playing, no matter what. So you got to get past that. But you want to set it to a value that's not unrecoverable. It kind of blew things out of the water when ICT presented a negative R strategy, but it's not about that. It's not about the R. So you don't want to be too negative. You don't want to have, a 10-point TP, but a 20-point stop loss. If your strategy isn't good, you will dig yourself into a hole. So having a positive R setup is more beneficial, but that's where leaving a runner comes into place. But just pick something that you can stomach, that you can walk away from the day and be like, yeah, I took a loss, wasn't that bad, come back tomorrow, and just kind of no skin off your teeth, you know what I mean? For me, that's 12 points, and I've gone as far as like looking at what's the average candle, 1 minute candle range after the market opens. What's the average candle range? And I'll set my stop loss a little bit above that. There's a million ways you can do it, and it's never going to be perfect. It's not. So if you're struggling with that too, like, oh man, if I just had set my stop loss here, it would have been fine. If I had just added a couple more points, it would have been fine. If I yada, 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 just pick one and go for it. That's it. I went with 12 points. And if we look at my spreadsheet, my win rate's pretty decent with that. Typically, I'll even scroll down. Typically, when it doesn't work out, 12-point stop, not enough. 12-point stop, not enough. 12-point stop, not enough. The trade goes, but 12-point stop wasn't enough. It was a volatile day, and it took me out and then went in the direction I thought. So I just want to talk about that a little. Just pick something, because losses are going to happen. There's no way to avoid it. Pick something you can stomach. 1 or 2 losses a day. Stick to some other kind of risk management. Don't allow yourself to set a limit for yourself. Mine is 2 losses a day, and I'm done for the day. That's it. Today's not going well. Whoop-de-doo. Took 2 losses. I'll come back tomorrow and I'll get them back, or later in the week and I'll get them back. You don't want to just keep trading on a day that isn't going well, because you're just going to keep taking losses, and you're going to dig and do a huge $1,000 plus negative hole. So then, as far as public spreadsheet, what I'm actually going to do is I've got a bunch of stuff on this spreadsheet. I've got a back test of Nexus Blast. These are all live, actually. These were all live trades with Cam's model. I do think I have a back test of it somewhere. I'm not really sure. The first couple trades here were on demo to get a feel for it, and then I started trading it live. And some of them are pretty good. I mean, a couple 20-point moves in there. So these are, I think, were all live trades. Most of them have screenshots, and then my inverted fair value gap back test. Yeah, I think I'm just going to make this public, this whole sheet. And I'll put the link in the description. Well, once you click on the link in the description, if you go up to File, Make a Copy, you can make your own copy and be able to edit and change things as you want to. So I'm going to put that up there for you guys, for everybody to see. All my back tests, all my trades, except my live. All my live stuff is on a different spreadsheet now. My account balances and withdraws and all of that stuff doesn't really need to be public. So I figured I could at least give this to you guys so you can study it. You can see exactly, you know, how I see things, some notes as to why I see things. So that's all I have for this video. It indeed did go a lot longer than I thought. So check out those timestamps at the bottom. Thanks for sticking through all of my yabbering. And if you have any questions, obviously there's comments. You can leave comments with questions that you have. And then in the community section, the community tab thing, I put a post up for Q&A. So any other questions you guys can think of, you can drop them in there too. Again, thanks for tuning in, and we'll catch you next time. Bye-bye.